Assalamu alaikum. Mumtaz Khan here, and I am the official representative of CDC Ajara. And I'm really happy to know that people are here to have this presentation where the president of CDC Ajara, Mr. Shoaib Sharif, will share the information with you. And he will also discuss all the operations of the transaction and how the Ijara works over here. And then at the end of our seminar, we just have the question and answer session, which you can just raise to Mr. Shoaib, and he will be happy enough to answer your queries and clarify the things regarding the Ijara financing, that is halal home financing over here in Canada. So I will not let you wait for more. So I will call Mr. Shoaib Sharif to start his presentation and discuss about Mr. Shoaib.
Thank you. Okay, assalamu alaikum everybody. Thank you for joining us. I wanted to basically give you a quick overview of what my presentation is. Essentially, I want to first talk about who is Ijara, CDC, Ijara Community Development Corporation. What is the Sharia authenticity of our product? Like, the most important thing people want to know is what we're doing halal, right? That's the most important question people have, so we'll talk about that. We will discuss what is riba, what is the thing that Muslims are trying to avoid. Why is it important for Muslims to avoid riba? I think we all know this, but we'll touch upon a few points. And then in general, the educational part of my presentation is to talk about methodologies. How do you do Islamic finance in general? And then we'll talk about what to expect during the application process with us, and some more details on how the Ijara program works. So to start, who is Ijara CDC? Ijara Community Development Corporation is not a bank, and we're not a lender. What we are is a structuring company. What does that mean? Well, we work with institutions, banks, credit unions, trust companies, and even private individuals, people that want to do Islamic finance, but they just don't know how to do it. And on the other side, we work with consumers like yourselves that are trying to access Islamic finance, but you don't know the first thing about how to go about doing that. And we put the two of you together, utilizing our documentation and process, basically our intellectual property, right? So if you have an institution that wants to do Islamic finance, what do they need to do? They need to establish a Sharia board, they need to develop contracts, they need to make sure that they're legally certified, that they meet all the federal, provincial, and other lending requirements, and that's a big expense. So rather than an organization going through and doing all of that, they would just come to us, license our product, and essentially plug and play with what they do, so they can almost immediately start offering Islamic finance transactions. Okay? So we're not the first company to offer Islamic financing in North America, but we are the first company to be able to offer an Islamic finance solution in all 50 states. We're also the first company to be able to offer commercial financing and nonprofit financing also in all 50 states. Nonprofits mean schools, masjids, community centers. We're also the only company that's able to do what's called an SBA-backed transaction. SBA is the Small Business Administration, which is part of the U.S. government. And we're the only organization operating at our scale that's actually a true nonprofit. We're a 501c3 nonprofit. And lastly, we started operations in Canada in November of 2008. So November of 2008, we're now in 2020. Almost 12 years in existence in Canada. Now there's a lot of companies that have come and gone. There's a lot of companies that have tried to duplicate us. But know this, we started a long time ago, we have a lot of history, we're a stable company, and at the end of the day, do you want to work with an organization that just started up or that reinvented itself, or do you want to work with an organization that has a long history, is stable? Remember, buying a home or business is the biggest investment that you're probably going to have. Do you want to trust that to an organization that is not well established? The good news is that you have a choice. And Ijara CDC, hopefully you'll find out and agree, is the best choice for not only Sharia compliance, but also stability of your transaction. Okay? So let's talk about Sharia authenticity. This is probably the biggest concern that most people have. Most people want to know that what we're doing is certified and has been reviewed, and who are the scholars that are involved. Well, there were many scholars that were involved in the creation of the Ijara contracts and process. And they issued a fatawa or a fatwa, which is basically an Islamic certificate of approval. Now, we all know that these certificates of approval are not necessarily issued by one individual. It's usually a group of scholars that issue a consensus opinion. And that's what we have. We have a group of scholars that have developed these contracts and processes to be not only Sharia compliant, but also maintain that Sharia compliance within the context of not only federal law, but provincial law, and also keeping track of consumer protection laws and other lending laws. So the original contracts were developed and approved in 1995 by an organization called Dala Al Baraka Group. Now, Dala Al Baraka, based in Saudi Arabia, was the go-to organization if you wanted to do any kind of an Islamic financial product, whether it's a mutual fund or a stock offering or a checking account or a finance product. You went to Dala Al Baraka for a fatwa or a certificate of approval. So the original contracts were approved in 1995. Then it was licensed to UBK, United Bank of Kuwait, and the fatwa was updated again in 1997. They did about 50 million in transactions, then closed their U.S. operations. If you recall, first Gulf War, Kuwaiti assets got frozen. Well, say no more. The fatwa was updated again in 2003 after we introduced it to University Bank, which is now MyUIF. And we consider MyUIF to be our biggest success story because it's one of the banks that we introduced to doing Islamic finance. In 2007, these two scholars, Sheikh Schleibach and Dr. Main, they're both part of UMJA, the Association of Muslim Jurists of America. They approved our transaction for the acquisition of Islamic American University's campus. So in 2007, IAU wanted to purchase a facility for their campus, and these scholars studied everybody that was out there, all the processes that are out there, and they decided on Ijara and the Ijara methodology to fund that campus acquisition. Then in 2009, shortly after we started in Canada, Sheikh Omar Ismail, who was based here in GTA, updated the fatwa for use in Canada. And Sheikh Omar was a former student of Justice Taqi Usmani. Then in 2012, it was updated again by Mufti Munir. Mufti Munir was also a former student of Justice Taqi Usmani. 2013, it was updated by Imam Yahya. In 2015, by Imam Mardini. So a lot of people would say, oh, Ijara, you have a fatwa that's 25 years old. Yes, but we know the Sharia doesn't change, but because we know that laws in North America do change, we've updated the fatwa along the way. Because we want to make sure that our transaction remains compliant with not only federal laws, but provincial laws and other lending laws, right? So we have done that, and we maintain a very stable transaction because of that, okay? We have available too the original fatwa that bears the signature of the three main scholars. Mufti Taqi Usmani's signature is on here also. And we also have the original documents with Justice Tucky's signature on each page. So people can look at the documents and process we're using today, compare it with what was approved in 1995, and know that the transaction is the same. Okay? Then we also have available the certification by Mufti Munir that he reviewed the original contracts and process, he reviewed the contracts and process we're using currently, and he certified them to be the same. So what is riba? What is the thing that Muslims are trying to avoid? Well, most people would probably define riba as being interest, right? Would that be a fair assessment? Well, there's two types of riba. There's riba nasiya, which is the interest that's lent on money, but then there's also riba al-fadl. Now, riba al-fadl is a little bit more complicated. The most common example that the scholars give in any text that you read will be that in the trading of dates or trading of commodities. So, for example, if you were to give me, 10 kilograms of high-quality dates, and I repaid you with 20 kilograms of lesser quality dates, there could be riba al-fadl there, right? Well, what exactly does this mean to us in today's thought process, right? Because we don't go around trading dates and other commodities that way. Well, a simple example would be, let's say you gave me an ounce of gold today, and a year from now I gave you back 2 ounces of silver, right? I'm repaying you with something of lesser value, but more of it, okay? There could be riba al-fadl there, right? If you gave me an ounce of gold today and I gave you that same ounce of gold back a year from now, is the value of what I'm giving you the same as what you gave me today? Maybe, maybe not, right? Because the value could be more or it could be less. We know that the value of gold fluctuates, correct? So you have to have some way of keeping the values the same as effectively what riba al-fadl is addressing, right? So we don't need to go into a really deep understanding of the both types of riba. It's just really important that you know that our transaction is going to avoid both types of riba, right? So people, if they ask me, oh, Brother Shoaib, is there any interest in your transaction? I will generally always answer them by saying, there's no riba in our transaction because we're going to avoid not only the riba that's interest, but also this other riba, which is riba al-fadl. You're going to avoid both types of riba, okay? And people are generally not aware of this. Most people think that the only thing that they're trying to avoid is interest. Well, it's a little bit more complex than that, okay? I get people sometimes that think that if you were to, for example, borrow $300,000, right, over 25 years, which is 300 months, that they only have to pay $1,000 a month. That's Islamic finance. I took $250,000. I'm giving you back $250,000 over 25 years. Well, the fact of the matter is that there could be riba al-fadl in that because the value of that $1,000 you're giving me back in month 200 is not the same as the value of what you got today, right? So that's also a miseducation or a misunderstanding that people have. They think they know what Islamic finance is, but really they should leave it to the scholars and do more in-depth reading because just coming up with a conclusion on your own could be very dangerous because you might be entering into riba al-fadl thinking that you're avoiding riba nasiya. You're avoiding the interest because that's what it seems like, right? But there's this other concept that we also need to be aware of, okay? So that's all I'm going to say about riba unless anybody has any questions. Yep. Okay. So why is it important for Muslims to avoid riba? Well, we all know, right, that if you participate in riba, you declare war with Allah and His Messenger. So obviously nobody wants to be at war with Allah and His Messenger, right? So how much more trouble would we be in if we guided you into riba? I think we'd be in a little bit more trouble, right? So, but we believe in our scholars and we believe in the process and we follow very strictly the process. We don't take any shortcuts in the process that we've been given. So we believe that we're not guiding people into riba, that we are in fact helping them be able to purchase homes and be free from riba, Okay? The other thing I want to point out is Surah Al-Baqarah, Ayah 275. A lot of people say, well, what you're doing sounds just like what the bank does. Oh, the cost is this much. It's the same cost as the bank. Well, there's nothing in anything that you will read about the cost of a transaction. Even this verse, Ayah 275, Surah Al-Baqarah, says that Allah has permitted trade and He has forbidden riba, right? Does that have anything to do with cost? No. It has to do with how the profit is earned. An Islamic transaction can cost more, it can cost less, or it can cost the same as a normal mortgage transaction, right? The good news is that many years ago, Islamic transactions were, and actually in some organizations, still Islamic transactions are almost 4% over the market, right? With us, we don't mark up the rate. We're a non-profit, so we don't mark up the rate from the investor. So you get basically the cheapest Islamic finance rates that are available in the market today. So most of the investors that we work with are banks, credit unions, trust companies, some private, but mostly institutions. And so whatever their market rates are out there will be the same rates that you will get without a markup. And that's the good news, because you're not going to really pay anything extra for having an Islamic transaction than you would for having a normal mortgage. So there's no excuse to not get into this transaction because it's not really costing you more, right? Some people say, oh, I don't want to do Islamic finance because it costs more. That's not an excuse anymore, because it's the same cost, right?
What is the difference between the rates, traditional financing and Islamic financing?
Well, the way we do it, the rate is the same. So, for example, today, I think it was RBC, or it was Royal RBC, just announced that the rates dropped 0.5%, right? So that will reflect in the transactions that we do also, okay? Because it'll be the same rate that the banks are offering. We're not marking up that rate. A lot of institutions may be, 5, 6, 7% because they're marking up a rate to make a profit. We're a non-profit. We're not marking up the rate. We're only charging a $20 a month admin fee. That's it.
Some of Islamic financing is also equal to the rate equal to the second mortgage lenders. 5 or 6% is normally the second mortgage lenders.
Right.
So,
But this is not the case. We're dealing primarily with first mortgage transactions that are essentially just the same rate as if you walked into TD Bank or RBC or Street Capital or anywhere else. You're getting the best rates that are available without markup.
like if the prevailing rate for big 5 banks like TD, RBC is 2.5% for say. For
Same.
example,
Be the same.
so then you're doing it the same rate.
We're not marking up the rate. We're only charging a $20 a month admin fee.
$20 per month.
$20 a month, which is better than marking it up 30 basis points or 0.5% or 2%, right? Like some other organizations might, right?
$20 regardless of the size of the
$20 a month. Doesn't matter.
fix.
Fixed. That's it. Okay, so let's get into generally how do you do Islamic finance? Okay, there's 7 ways to do Islamic finance, 3 that really fits in with North American laws. The first is murabaha, which is an installment sale. You buy something for one price, you mark it up, and then divide the marked up price over time. Pretty simple, straightforward. Then there's musharaka. Sharaka means to share. This is a partnership. More specifically, it's a declining balance co-partnership. And then there's ijara. Ijara means rent or lease. Ijara wa ikhtina is rent with acquisition or rent to own. Okay? So let's look at murabaha, installment sale. Let's say you buy a home for $100,000. You mark it up to $180,000 over 25 or 30 years. Here, my example here is 30 years, 360 months. And I like to, for these examples, just use easy math, right? There's a more specific calculation, but roughly speaking, this is what it would look like. Over 30 years, 360 months, your payment is $500 a month. Pretty simple, straightforward, right? Well, one of the problems with Murabaha is that you cannot have a written discount made into the agreement, right? So the financier can give you a discount at their discretion, but they're not required to, number one. And number two, if they write a discount into their contract, that may be considered a riba contract. So it's not permissible. Remember, all these things I'm going to talk about are the legitimate ways to do these transactions, not necessarily some of the shortcuts that are out there. We want people to be educated on how these things are supposed to work, not the way that people try and get them to work, right? Make sense? So, as an example, let's say after 5 years, that home went up in value, right? It went from 100 to 140,000. That's great. It went up in value, right? And maybe you needed to sell the home because you wanted to buy a bigger home, or you got a job relocation. Now you got to move from Mississauga to Markham or to Edmonton, and there's reasons to why that might happen. But guess what? Your contract is 180. It doesn't matter when you pay it. You're responsible for paying the full balance, right?
Regardless, you made payment early.
Even if you paid after a year or 6 months, it doesn't matter. Your contract is what you're obligated to. Now, the financier may say, oh, it's okay, we'll give you a discount. You're paying it early. But they don't have to, okay? So you're really at somebody else's mercy to decide whether or not they're going to give you a discount or not, right? Contractually, there is no discount that's permissible. I mean, no discount. You can't write it in and have a permissible transaction. So effectively, it's costing you $40,000 to exit this contract, right? Make sense? And again, easy math. I mean, there's other calculations to get involved in this.
More than 40,000 because you paid off early and you lost your value as well because the market value is 140,000 and you have fixed to pay at 180. So instead of gaining, you are paying out of pocket.
It's possible, yes.
So
It is possible.
Two-way loss.
It's possible,
You are
yes.
losing the value
Yep.
of your capital gain you earn.
Right,
That's all capital gain you pay to the company
right,
and out of pocket 40,000.
right. You must be an
That's
accountant.
double loss.
I said, you must be an accountant because you caught that very quickly. Most people don't get that. Yeah. Because, I mean, this is really, not necessarily the best transaction for real estate, right? But this is one of the transactions that's out there that's available. The other issue with Murabaha is that there are probably 2 transfer taxes at closing, right? Because every time property changes hands, there's a land transfer tax, right? So in order for Murabaha to work, the financier has to take possession of the property first and then sell it to you at the higher price. Now, if anybody thinks the government is not going to collect their tax, they're dreaming, right? Government always collects their tax. Would you agree with that? So when the financier takes title to the property, 1 land transfer tax. They then transfer the second time, a second land transfer tax. Now here in GTA, the land transfer tax can vary between 1% and 3%, right? Could be pretty high. So that's the other drawback. And some people may not even know that there's a second transfer tax because it may be built into that 180 contract price, right? But for sure, the financier is not going to pay it. That cost is going to get passed down to you. So we would use Murabaha for like something short term, like an auto finance or an inventory finance, right? Just like when you go to the bank, if you want a car loan, they're not going to give you a credit card, right? If you want a credit card, they're not going to give you a mortgage, right? Every transaction that the bank does has separate documentation, right? Same thing with Islamic finance. Each process has its highest and best use. Now we can take a square peg and try and push it through a round hole because for a variety of reasons, But there are better ways to do things. This is ideal for something short term. You can see that it's not necessarily ideal for a long-term
That
transaction.
was my second question. In fact, Morava financing normally used for the trading purpose. Like the short-term trading, you want to buy goods on deferred payment basis.
Right.
Divide it and then sell it.
Oh, that's
Right. Right.
Oh yeah, that's the reason. Because
Right.
it's normally popular with the auto or inventory.
Right.
It's not, I have not heard about the Morava financing is used for the long-term financing.
Oh, it is.
See, that was my second
There's
question.
people in GTA area that use Murabaha.
Yeah.
Yeah, because people don't aware of all these things.
Yeah.
They are doing this.
Right.
Maybe you know about this thing, you can come up with the things, but maybe like layman like me, if I'm feeling, oh, I'm doing the Islamic financing, but on the background, they're doing this more.
So any questions on how Murabaha works? I think we're pretty,
I know.
you have a pretty good
For
understanding.
trade financing.
Trade financing, essentially, that's the ideal, the best use of this structure. So let's look at Musharaka. Musharaka is a declining balance co-partnership. It's better than Murabaha because you only pay the balance when you're paying off or selling. So that's good, right? You do have to form a partnership, and typically the property is taxed at the investment property tax rate, okay? And this varies from community to community. Some communities, if you live in a home, well, actually in every community, if you live in a home, that's considered your homestead. But if you own the same home as an investment, then the property tax can be as much as 30% more. And again, that varies from community to community. But because there's a partnership on title, the property taxes are generally going to be more because the taxing authority is going to see the partnership and say, oh, this is an investment property. They're going to charge you more, usually. And because you have a partner, you have to share according to your percentage, right? So if, let's say in this transaction, the same house, you owned it for 5 years, let's say you put 5% down when you bought it, you made some payments, now you own 20%, right? So that means that 80% is owned by your partner, 20% is owned by you. So 80% of that gain of $40,000 goes to your partner, that's $32,000. The other $8,000, which is the 20%, comes to you. And the 20% of the original $100,000 comes to you also, right? So out of that $140,000, you end up with $28,000, which is better than writing a check for $40,000. Wouldn't you agree? Yeah, significantly better, right? So this is a better transaction for, better than Murabaha. But again, when you want to take title into your own name after you finish the transaction, again, there could be a transfer tax, 1 to 3%, right? You need permission from your partner. You have a partner. You need permission from them, even if you want to sell the property. Somebody has to sign off, right? So again, the destiny of your property is not in your hands. It lies with somebody else. They happen to be your partner, but it lies with them as well, right? They can say, no, I think the property values are going to continue to go up. I don't want to sell right now. They probably won't, but they have the right to, right? And so we use Musharaka for a business goodwill or an intangible asset. A business goodwill is the value of a business above and beyond its assets, right? If you're buying a business, you know the value of the inventory, you know the value of the building, you know the value of the equipment, right? But what about the value of the reputation of the business, right? I know I can go to this coffee shop because they have the best scones in GTA, right? Well, they built that reputation over time. What is the value to that? And there's nothing tangible, there's nothing physical there. So for that, and also for a business line of credit, for example, our student loan program is based upon a Musharaka structure, right? So again, Musharaka has its highest and best use, and this would be one of the best uses for it, right? We recently did a pharmacy, for example, and the building, the drop ceilings, the floor coverings, the coolers, the shelving, the signage, the computers, point of sale system, everything physical was done with a Ijara rent-to-own structure. All of the inventory, including the pharmaceuticals, murabaha, and then the line of credit, the operating line of credit, a musharaka structure, right? So again, if you were to go to the bank and try and do, multiple, they would use different contracts for different pieces of the transaction. The highest and best use is what we're after, right? Any questions about musharaka? Yep. Okay, let's go. So that brings us to Ijara. Like musharaka, you only pay the balance when you're paying off or selling. You're taxed at the homestead property tax rate, the lower tax rate. There's legitimately no sharing of the profit or loss, right? In musharaka, for it to be done properly, there should be a sharing of profit and loss. The transfer tax is only $1, right? Who only wants to pay $1 for transfer tax? Compared to 1 to 3%, right? In GTA, it's $2. Pretty much everywhere else is only $1 transfer tax. And you don't need any permission from anybody to sublease the property, improve the property, to sell the property. You can actually just go right to closing and sell the property directly yourself. And because we utilize a trust in our structure, there could be some estate planning benefits, right? Do we all know what estate planning is? It's planning what happens to you after you die, right? And generally when I do these presentations, I ask the question, how many people have a will? And it's about 1 in 40 people in our community that has a will. And we're a community that thinks about the akhirah at least 5 times a day, right? So shouldn't we also plan for the inevitable as to what's going to happen with our assets? And our home is usually our biggest asset, right? So if we don't have a will, the trust can give us some estate planning benefits.
In will is okay, will is required as per the law, like in North America. But as per the Sharia, there is no will. Everything will be happening after that according to the Sharia rules. So how do you work? Like after the death of a person, do we go according to our Sharia rules?
Well, if you don't have it in writing, you have to go with the law that's here, right? So we should plan for what's going to happen to us because we know we're going to die eventually, right? And if we die here, we should say, okay, I want my son to get this much, my daughters to get this much, I want this much to go to charity. We want to be able to direct what's going to happen with our assets, right? And if you don't have a will, the government's going to decide.
So you mean that if a person has to make the will, means as per to show to the government, but they have to go according to the Sharia, what we given in Sharia.
Well, theoretically, the will should.
The son, 1/4 to the daughter, 1/8 to the wife.
Right.
In that way.
Right. That's how they would do their will, right?
Yeah.
But look, 1 in 40 people has a will. We don't plan for this, right? So if we don't plan for this, the trust can give you some of that planning.
It's not clear to me. Morality is like in rental lease or what sort of financing is?
It's a rent to own, and we'll get into that a little bit
I
more.
will own that one.
Rent to own.
Okay, it's not a rental lease. Like if you buy the car on the lease, you pay rent for a specific period of time, then give back your car to the.
Right. No, this is rent to own.
If you want to buy at the end of the lease period a specific value, the buyer and seller agree, you can buy at that amount. So it's not that type of lease.
No.
We're coming to that, I think.
Yeah.
You're thinking about a lease with a buyout. This is a lease to own. It's a little bit different.
Okay. So lease to you explain actually not right. That's
Because
not clear.
in the lease with the buyout, right? You're making a certain amount of lower payments with the expectation to make a balloon at the end of the term. Here, the expectation is by the time you get to the end of the entire period, that you'll have a zero balance, and you'll buy it out for $1. This is more like a $1 buyout lease.
Okay. So no sharing of profit or loss, like in between the lease period, like after 2 or 3 years, the property get appreciation.
You know what?
What happened? It's coming.
It's right there.
All right.
Perfect question. You led me right to the slide. Thank you. So,
I was a little bit early. You go on your way.
no, this
At
is
the end I will
good.
ask question because
No, this is perfect. This is perfect. So again, let's like look at what happens, at the time of sale. Now, it's true, right? I think you'll all agree that if you have two people that own a property, that you have to share according to your percentage, right? But if you have one person, who do they share with? Nobody, right? In our transaction, there's only one owner, and that owner is the trust, because we create a trust for every transaction, right? So that trust is a sole owner, and as the sole owner, it will receive 100% of the sale proceeds, right? So, and here, the property has gone up in value, and you've made payments, so your equity, your ownership, your on account has increased also, right? You can see that? You started with maybe 5% down, then you got 20% equity, and the property went up in value. So the trust is going to get that 100%. It's going to buy out the rest of your shares from the investor, and then whatever's left over automatically comes to you. And this is by Canadian law and Islamic law. Whoever the beneficiary is gets whatever's left over. So there's legitimately no sharing of the gain, okay? Now let's look at what happens if, for example, let's say the property went down in value, okay? And let's say it went down in value below what you owe, right? Let's say you owe $80,000, but you can only sell it for $70,000. Well, it's possible in that scenario that the investor could also take a loss. So while our transaction, there's no sharing of the gain, there could be a sharing of the loss. Does that basically answer your question?
I think almost.
Almost? Where did I not quite answer?
Sorry?
What part didn't get quite answered for you?
Still I'm thinking of this because it's literally a complicated transaction.
Okay, well, we can come back to it if something comes up. Okay? So let's look at a comparison of all three, right? Let's say you bought the property originally for $100,000. Property went up in value to $140,000. And let's say over that period of time, you built up 20% equity. This is our assumption. Well, with Murabaha, you owe $180,000. There's no sharing of the profit, but your contract is $180. You sold it for $140. You might be liable for a $40,000 payout, right? These are just some simple, easy numbers. With Musharaka, you bought it for $100. Your partner has 80%, so you owe them $80,000. They get 80% of the $40,000 gain, right? So that leaves you with $28,000, right? We understood that. And that's better than paying $40,000, right? We all agreed with that. Now with Ijara, you sold it for $140,000. The 80% that the investor has is $80,000. That's what you have to pay them to buy them out. So the difference between $140,000 and $80,000 is $60,000. That $60,000 comes to you.
It's all yours.
It's all yours, legitimately, structurally, Islamically, and based on Canadian law. That's 100% yours. No funny business, no shortcuts, no trying to sell you on, the math doesn't lie. Math is math, right? So you can see which one do you think is the better transaction for the customer.
It means every transaction, at the end of every transaction or every payment, you segregate what's my ownership change after
Yes.
this payment and what's I pay to your profit, what you have invested.
Yes,
So that's correct.
every month. Every month.
Every month or quarter, every transaction.
Every transaction. Yep. So, look, as a non-profit, we want to do the best transaction for the consumer. The investor is going to make their profit. Why should they make more profit, right? So we want to do the best transaction for the customer for long-term real estate. You can see the math doesn't lie, right? If I'm a pure for-profit, I want the maximum profit, This is the assumption I'm making. I should not make this assumption. Forgive me if this is the wrong assumption. But if all things being equal, I can do any method I want. If I generally pick this method, it's because I know I can make a huge profit, right? Here, I'm making a marginal profit balance between what's best for the consumer economically and what's good for my bottom line and my partners, right? So there's no doubt at all economically that this is the better transaction for the customer. Maybe this is better for the investor, but that's definitely better for the customer. Now, let's look at a different scenario. Let's say the property skyrocketed. It went from 100 to 180,000, right? And you made extra payments. So your equity is 50%. You own 50%, right? Well, the property is 180, contract was 180, zero balance, right? Musharaka, 50% is 40,000 of the 80,000 gain, right? And the balance is 80,000. You walk away with 60,000, right? Ijara, you owe 80,000. 180, 100,000. You walk away with more money.
Yeah. So all the profit is transferring to the, what I say is the borrower, not to the lender. Lender gets zero profit out of the capital.
The lender is making their profit, right, based upon the rent payment. They're not making an extra profit, right? This is an extra profit above and beyond the profit they already got each month.
No, I'm describing about the Ijara financing.
Yes.
The last column.
Mm-hmm.
All the amount of profit goes to the borrower, not
Yes.
to the lender.
Yes.
Lender got only just zero benefit out of the sale.
From the sale, they got paid back whatever their balance is and nothing more.
Nothing more. If you have paid back till 20%, just you get whatever unpaid amount.
Right.
In that part.
Whatever the balance
So
is.
the balance is there, the lender will take that amount from there and the rest of the money is for the borrower.
Not out of capital gain, zero out of capital gain. So why the lender is bearing the loss in other way around this situation on the downward side?
Property value goes down, goes down.
Well, look, the interesting thing is that there's a possibility in even a regular mortgage transaction that a lender could take a loss, right? In the case of a foreclosure, for example, right, there's a default. They're going to sell it. They're going to hire a realtor and they're going to try and sell it, or there's going to be a foreclosure auction or something like that. And if let's say they're owed 80,000 and somebody bids 50,000, they accept it. Well, they took a $30,000 loss. It happens, right? So there's a possibility that there could be a loss if there's a total collapse in the market. And also, there's such a thing as what's called a short sale. If the property values go down enough where you can't sell it for what's owed, then the lender may have to agree to sell it for less. But they'll agree, but they'll be sharing in that loss too.
So like in the mortgage, if you go down beyond your equity, then the lender has to bear the loss because the
Right.
equity in the house is whatever.
Right. But you're losing, and they're losing too. So there could be a sharing of the loss.
So don't go after the borrower's personal assets, other way around.
No.
Same thing in Ijara also. If you go below your equity, then you
Yes.
bear the loss.
Yeah.
Okay, so let's look at how Ijara works. Basically, we're going to create a trust. The trust will own the asset. There's going to be a lease-to-own arrangement between the trust and the customer. And each month you make a rent payment. A portion of that payment goes to ownership until the customer has 100%. You can make extra payments, right? You can pay it early, no penalty. You can pay it early. You don't have to pay the full contract. You just pay the rent until you take over 100% ownership. Pretty clear how it works? Pretty simple structure.
Early, like you want to pay in your, what you have borrowed against your principal. So you can pay.
You can make extra payments.
35,000.
You can,
Yeah,
yes.
I can.
Yeah. Now there are some restrictions, right? You can pay a maximum of 15% a year, and
Like a mortgage.
yes, exactly. But the point is, you pay it early, it's cheaper, right? Whereas some transactions, it doesn't matter if you paid early, you're still paying the full contract. Okay. So let's look at the rent payment.
One thing, we are doing we are doing the agreement, Ijara contract, suppose for 20 or 25 years, but it should not be straightforward for 25 years. Every 5 years it will be renewed.
Right, so the payments will be determined based upon a 25-year schedule, amortization, but the term of the contract will be 3 or 5 years.
Yeah, after 5 years,
It's eligible for
they
renewal.
can change the pricing,
It could, yes,
but that is to be agreed by the
by both
customer
parties, right.
or they will make the customer agree in upfront before doing the full agreement.
Well, it's not known what that's going to be
Yeah,
in 5 years.
yeah.
And the customer has the option to renew or refinance somewhere else or to pay the balance with whatever the current market. So, let's get into the payments. Your payment is divided into 3 parts, right? You've got part of your payment is going to profit, part of it is going to your on account of your equity, and the third part is the cost of ownership, taxes, insurance, and administration fee. Right? So, because your ownership increases with every payment, the following payment, your profit portion will be less, your ownership portion will be more, but your cost of ownership is basically going to stay the same. It'll change roughly once a year when your property tax or your insurance changes, okay? But your rent payment is going to stay the same, okay? So, for example, if you had 100,000 purchase, 20,000 down, 2.69 rate, 25 years, this is your monthly payment. This is how much the first month is going for profit. But as your ownership increases, the profit decreases. As your ownership increases, the more you pay, the more you own, right? It's the same math. Mathematically, it's the same amortization calculation. So it's pretty simple, straightforward. Yep. Happens every single month. Okay?
Taxes and government levies is also proportionate according to the size of the share.
I'm sorry?
Taxes and the other levies of the government
Yes.
are also proportionate according to the size of the share. Yes, I am going to pay you. My share is going to increase.
No.
I have to do more taxes.
No. You pay 100% of the taxes and the insurance. This is like a commercial lease.
Okay.
It's also known as like maybe a triple net lease.
Regardless of the proportion of the balance, the borrower pay 100% of the taxes and levies.
Right. It's additional rent.
Yeah.
Okay? So there's this additional rent portion covers 100% of what that is. Okay? So let's talk about a trust. I said we create a trust for the transaction, right? Who owns the trust? Well, a trust is a waqf. Are we familiar with waqf? There's 7 different types of waqf. There also happens to be 7 different types of trust. You probably noticed when you were at Umrah that on the back of some of the chairs it says, Al Medina Waqf or Al Haram Waqf, right? These are trusts. Waqf is actually an Islamic concept, right? So it happens to be adapted into Western law. And a trust is a unique entity in that it's an entity created in law, but it's not a physical entity, right? I like to think of it as a legal person. That helps me understand how it works better. It's a legal person. It functions on its own, right? Like, for example, one of the reasons why a trust can be a very good estate planning tool is that we may die, but the trust doesn't die, right? So you can, when you die, there's going to be an estate tax. Whatever assets you own are going to get taxed by the government, right? But if it's owned in a trust and the trust doesn't die, then theoretically you can keep deferring that estate tax. This is why people of wealth utilize trusts a lot, right? But while the trust does not have any ownership, it does have parties, right? And these parties are, number one, the grantor. The grantor is a person that grants or gives something to the trust, right? When you give your right to purchase, your purchase agreement to the trust, that makes you the grantor, right? If you're refinancing, you're giving the title to the trust. Again, that makes you the grantor. Then the next person is the beneficiary, and the beneficiary is also you. We created with you as being the beneficiary, so you get all of the benefits from the trust. Now, only the grantor can change the beneficiary. So down the road, you have more kids, you can add more kids, right? Your kids grow up, you want to add your grandkids, you can do that, right? You can make any change to beneficiaries at any time that you want. You can determine what percentage goes to who, right? If you want to put a relative or somebody else on, you can do that. You can make another trust the beneficiary if you wanted to, right? Then you have a trustee. The trustee is the manager of the trust, and that's Ijara. Now, Allahu Alam, we're here today, could be gone tomorrow, who knows, right? So when we create the trust, we create it with you as being an initial trustee, and then Ijara gets added as a co-trustee. So that if something happens to Ijara, it doesn't matter, you can automatically take over the operations, okay? Then the last piece is the investor, right? So now, earlier I said that, the transaction is, you make a monthly rent payment, part of that payment goes to ownership till you own 100%. And then I just said that there's no ownership in a trust, right? Well, it's not really a conflict because what it is in a trust is actually called beneficial rights to ownership. But because beneficial rights to ownership is a big mouthful to say, we kind of shorten it and say ownership, because the concept is essentially the same as ownership, except in a trust there's not really ownership, it's actually beneficial rights to ownership. So if you start the transaction with 5% down, then you have 5% of the beneficial rights to ownership, and the investor has 95% of the beneficial rights to ownership. So with every payment you make, you're taking over more of those beneficial rights. Make sense? Okay, let's move on. Oops. So, what is the Sharia issue with a mortgage? Well, the most common answer is the interest, right? Well, the word mortgage actually means mortgage and note, right? It's one word that means two different things, right? Now, I'm from India, so I'll give you an example. Like, when I was growing up, I would ask my mom, "Khana ke liye kya hai?" Right? What's for dinner? And she would just reply to me and say, "Khana." Now, to me, khana is dal chawal, right? Rice and lentils, right? I asked her what's for dinner, and she gave me the same word back, but I understood what it meant. So here, commonly, it's kind of the same thing with the word mortgage. Loosely refers to mortgage and note. Two separate instruments, okay? Now, the mortgage is actually a security instrument. It's a rahan, right? If you actually read the mortgage, there's no reference to interest, right? People say, "Oh, Ijara, they make you sign a mortgage." Yeah, so what? Sign a mortgage all day long, 3 times a day if you want. There's nothing wrong with a mortgage, okay? Now, we all know what rahan is. There's this a story of the Prophet, peace be upon him, where he gave a shield to his neighbor and he borrowed some money, right? The act of giving the shield is known as rahan, which is security. So we know from the hadith that I'm sorry, not hadith, the sunnah of the Prophet, that security is permissible, okay? Security is permissible. And it's proven to us through this act of the Prophet, peace be upon him, giving his shield to his neighbor. The issue from an Islamic perspective is the note. The note is the evidence of interest. And how is the bank going to make their profit, their interest, right? Because normally, all of the bank's profit is built into that note, right? In our transaction, all of the profit is built into the lease, right? It's basically the same payment. We're just adding a $20 a month admin fee, but the payment is the same because the mathematical calculation is the same. So how do we move the funds from you to the trust to the bank, right? From you to the trust, easy peasy, lease to own, I understand that. How are we getting it to the bank? That's a little more complicated, right? How do you do that without a note? Well, you have to think of an Ijara transaction more of a commercial transaction, right? In a commercial transaction, there's this legal document. It's called an assignment of rents and leases, right? So if I came to you as the trust and I said, oh, bank, give me $15 million, I want to build a Canadian Tire, right? You're going to say, okay, show me what you own. I don't own anything. I just have this piece of property. Okay, show me your income. I don't have any income. I have this lease. Okay, well, let's evaluate the lease. Okay, Canadian Tire, good stock price, good credit rating. Okay, fine. Here's $15 million. Go build that Canadian Tire. But because you don't have anything, and because all of the cash flow that you have is built into that lease, I need to know that I can access that lease. And the way the bank accesses the cash flow of that lease is through this document, assignment of rents and leases. So if you want to follow the money comes from the customer, from you to the trust, then the trust then assigns it to the bank. So they are earning their profit through the lease. The same profit that they would be making before, but now it's a rent on property transaction. Okay? And the customer, you're going to have to sign the mortgage to give security in the property. Okay? So, then, most people will ask, well, what's the, how can you define a percentage if you're doing an Islamic transaction, right? So let's say you have $100,000 in cash. You go out, you pay cash for a house, and then you rent it to me for, let's say, $500 a month. At the end of the year, you're going to collect $6,000 in rent, right? That $6,000 is a 6% return on your original investment. Is that 6% rent or is it interest? It's clearly rent, right? I'm paying you to use the property, right? Agreed? Well, in a normal mortgage transaction, meaning mortgage and note, right? You give me the $100,000. I use that money to buy the same property, and now I pay you the same 6%, but now I'm paying you 6% for the use of money, right? Rent on money is riba. Rent on property is trade, right? This is a trade. If I'm paying you to use the money, that's a riba. Same 6%. Just one is permissible, one is not. Okay? So let's talk about consumer protection issues. First of all finance companies have to comply. The basic requirement is that no matter how you earn your profit, you have to describe that profit as a percentage, and more specifically as an interest rate. And if you don't, there could be triple damages, right? What does that mean? Well, it means 5 years, 7 years, 10 years from now, go get a lawyer, come back, oh, Ijara or investor, under my consumer protection rights, you were supposed to disclose the profit to me using this form. It says interest on it, but you didn't do that. So guess what? I want my money back. I'm going to keep the property, and you're going to pay me on top. Triple damages, right? And because the liability lies with us and the investors, the scholars say, yes, we can require you to sign these disclosures, right? And because we have to comply with consumer protection laws. But it's okay because the one of the concepts of Islamic finance is that there should be no gharar in a transaction. There should be no deceitful practices, right? Which basically means, look, if I came to you and said, oh, brother, don't worry about it. The profit's only $500 a month, right? You might say, okay, that doesn't sound too bad. But if I have to tell you it's 6%, say, wait a second, the rest of the market is 2.15%. Why are you charging me so much, right? So this is what the government wants, right, under the consumer protection laws and Truth in Lending Act and so on, It's for you to be able to easily recognize what the cost of a transaction is. And the easiest way to recognize that is based upon this percentage, right? Now, the scholar, one of our scholars gave me a good example. He said, look, you go down to the city and you look up the masjid. And you will see that it's classified as a church. It's under a church zoning. Look at the building. It looks like a masjid. It's used as it is a masjid. So we don't care how they classify it. We know what it is. We don't care that this little piece of compliance paper says interest. We know that it's not, because we know the profit is earned as a rent on the real estate, not as a rent on the money, right? Make sense? Any questions? No? Okay. So basically, same things in terms of what you need to apply. Basically, all the same things that you would with a regular mortgage, right? I mean, if you were to, it's the exact same process essentially. Oops. Any questions on the process? I mean, basically, you're going to apply, do an application online. We're going to collect some information from you. We're going to give you a pre-qualification. You're going to go out shopping for a home, and you're going to give us a purchase agreement. Once we have the purchase agreement, we'll work towards closing. Whole process can take less than 30 days. Any questions? Okay, great. Well, thank you for joining and attending.